Welcome to the Microcap Brief. Today, we are going deeper into the world of due diligence. In our past episodes, we've covered the big, obvious red flags, the going concern warnings, and the delisting notices. But today, we're going to teach you how to move beyond the headlines and analyze a company's filings like an expert. To do this, let's frame our discussion with an analogy. Think of investing in microcaps not as a walk in the park, but as an elite mountaineering expedition. The potential rewards at the summit, finding a hidden gem before the rest of the market, are immense. But the environment is harsh and the risks are real. A casual hiker will get into serious trouble, but a skilled, well-equipped mountaineer who knows how to read the weather and spot the signs of an avalanche can navigate the dangers and reach the peak. This podcast is your guide to becoming that skilled mountaineer. We've already taught you how to read the map, the SEC filings. Today, we're going to teach you an advanced skill, how to spot the subtle signs of danger that most climbers miss. Think of this as learning to read the snowpack for avalanche risk. A press release can tell you it's a beautiful day for a climb, but the filings contain the real data about the underlying stability. We are going to show you 7 advanced warning signs that tell you when it's time to be cautious and reevaluate your route. Warning sign number 1, the change of auditors. The sign: a company suddenly fires its independent accounting firm and hires a new one. Why it's a warning? Your auditor is like the independent geologist who verifies the stability of your path. When a company changes auditors unexpectedly, it can be a sign that the geologist found an instability, like a disagreement over accounting practices, that the expedition leader didn't want to report. It's a critical signal to check your safety lines. Where to find it? This must be disclosed in a Form 8K. If you see one of these, your due diligence needs to go into overdrive. Warning sign number 2, related party transactions. The sign: the company is doing significant business with its own executives, directors, or their family members. Why it's a warning? This is a sign that the expedition's supplies might be benefiting the leaders more than the team. Is the company paying an executive's family member an inflated price for a service? While not always improper, it creates a major conflict of interest and suggests that shareholder value may not be the top priority. Where to find it? This evidence is found in the Notes to the Financial Statements section of the 10K and 10Q, usually under a heading like Related Party Transactions. Warning sign number 3, skyrocketing accounts receivable. The sign: on the balance sheet, the company's accounts receivable are growing much faster than its stated revenue. Why it's a warning? Accounts receivable is the money owed to the company. When this number balloons, it can be a sign that the company is booking sales to customers who can't or won't pay. It means the reported growth might be an illusion. A more advanced check is to calculate the Days Sales Outstanding, or DSO. A rising DSO trend means it's taking the company longer and longer to collect cash from its customers, which confirms the problem. Where to find it? This requires analysis of the balance sheet and income statement in the 10Q. Compare the growth of accounts receivable to the growth of revenue and track the DSO trend quarter over quarter. Warning sign number 4, the shelf registration. The sign: a company files a Form S3, also known as a shelf registration. Why it's a caution flag but not a stop sign? An S3 gives a company pre-approval to sell new shares quickly if it chooses. Think of it as the expedition leader packing extra rations just in case. It's not inherently bad, it's a tool for flexibility. The warning for microcaps is how they use this tool. If a company immediately uses its S3 to flood the market with new shares at low prices, especially through a toxic financing vehicle like an equity line of credit, it's a clear signal of impending dilution. The filing itself is neutral. The subsequent action is what should trigger your caution. Where to find it? You will see this filed as a Form S3 on the SEC's Edgar database. Warning sign number 5, the repricing of warrants. The sign, a company announces it is lowering the exercise price of outstanding warrants. Why it's a warning? Warrants are often given to the financiers who funded the expedition. If the company's stock price falls well below the warrant's exercise price, those warrants become deeply out of the money and lose most of their value. By repricing them to a lower level, the company is handing those financiers a massive advantage, a second chance to profit that isn't available to regular shareholders. It strongly signals a management team that is prioritizing the interests of its early financiers over those of its common shareholders. Where to find it? This will almost always be announced in a Form 8K that details an amendment to a previous financing agreement. Warning sign number 6, compensation not tied to performance. The sign, the CEO and other top executives are receiving huge salaries and bonuses, even while the company is losing money and the stock price is falling. Why it's a warning? This is a sign that the expedition leaders get paid whether they reach the summit or not. You want to see a significant portion of compensation, especially bonuses and stock awards, tied to clear, measurable performance metrics. Be wary of metrics that are too easy to hit or can be easily manipulated. Look for alignment with long-term shareholder value creation, not just short-term stock pops. Where to find it? All the details of executive compensation are laid out in the company's annual proxy statement filed with the SEC. And finally, warning sign number 7, vague use of proceeds. The sign, a company raises money by selling new shares and is extremely unclear about how they plan to spend it. Why it's a warning? While for general corporate purposes is a common and legally necessary phrase, be very wary if it's the only description offered, especially by a microcap. You should look for a detailed breakdown. For example, $2 million for R&D, $1.5 million for sales expansion, $500K for working capital. A complete lack of specificity is a sign of poor planning and gives management a blank check with your money. It demands much greater scrutiny. Where to find it? This is found in the offering documents for a new stock sale, such as an S1 or a prospectus supplement. Your key takeaway is this: the path to the summit is often found in the fine print. By learning to spot these 7 advanced warning signs, you can better navigate the risks and make more informed decisions on your microcap expedition. Thank you for listening to the Microcap Brief. Now you're equipped to scout the trail ahead. Happy investing.